Okay, welcome in everybody. Thanks for joining us today. Today we're going to be talking about blockchain and Bitcoin in particular. So just quickly, before I jump into too much detail, don't forget that any advice contained within today's presentation is general only, so it isn't tailored to your particular circumstances, and you need to decide for yourself whether it's appropriate to you. So just a little bit about ourselves. So Emerald Financial Group, we basically exist to help investors make informed decisions about their investments. We offer a range of services to help educate, support, and motivate everyday people to get involved in the stock market. We offer services for any experience level, whether you're a trader or an investor. There's two main brands to our business: Trader Circle, which looks after the more shorter term trading and recommendations, and there's Emerald Financial, that's more into the research side of it, more into the fundamental analysis and portfolio management. But today we're going to be joined by the team from Banyantree. Banyantree supply us with a lot of the analysis that we use to make informed decisions on the market. The team at Banyantree are going to talk in a lot of detail around blockchain technology, Bitcoin, and how it's really going to change the industries in the near future. But before I hand it over to the Banyantree team, if you want to see the recording of today's session, if you don't quite catch the whole thing, we will be emailing out a recording or a link to the recording of this presentation today. We're also going to be loading that onto our YouTube page. So I'll just put that link to the URL now, into the Q&A box now. And then, yeah, you can jump on and see the recording there. So I'll hand it across to you, Max and Zach, to kick this off and get into a bit of detail.
Thanks, Tim, and thanks everybody for joining us today. Hopefully, you can see. Let me just stop sharing. Sorry. Yeah, hopefully you can see my presentation. Look, I'm not going to spend too much time on Banyantree. We've got a lot of clients that have been with us for many years that know us. But for those that don't know us, we are an investment manager, a research house based in Sydney. We've been around for more than 5 years. Our mission really is, at the end of the day, to deliver outperformance at low fees through our research agenda and through, obviously, the investment strategies we manage. Regardless of what our previous experience at other firms, the team in its current format has a strong track record of delivering returns through, I guess, what's been interesting, unique trading environments over the last 5 years. The team as a collective have over 50 years experience. We've managed money through the GFC, through our research agenda and our deep dives into ideas like Bitcoin and lithium and other stuff. We're still looking to deliver these stable returns. So these are not high octane strategies that we deliver to clients. They're stable, 8 to 12% per annum through the cycle kind of strategies. We've got no style bias, and we look at every opportunity its own merits. And that hopefully shows through our performance of our key investment strategies, not just on the global, but also on the Australian domestic. These are the three key strategies that we run, and you can see not just since inception days, but also in calendar year 20, which was a very interesting year, we delivered really strong returns. If you want more information, please get in touch. But with that, I'll really like to pass it on to Max and Haroon, who will be taking you through what is a pretty interesting exercise into Bitcoin and blockchain. Thanks, Haroon and Max.
Okay, great. Thank you, Zach, and thank you,
Thanks,
Tim.
Mate. Max.
Before I introduce Haroon, I'll actually let him do that. Let me just give a bit of a background as to why we're here today. I've known Haroon for a number of years. I knew that he had a background in cybersecurity and knew blockchain and Bitcoin sort of space quite well. I visited him in Dubai, where he's got a sort of a mining operation. Sort of didn't really pay too much attention to it at the time. We showcased the whole sort of apparatus and the infrastructure that goes behind it. This was back in 2019 mid, and that. I think at that time the Bitcoin price was around to 15,000 US or thereabouts. So I didn't really think too much of it. But fast forward about a year or so, mid last year, Bitcoin started to take off a little bit, and then latter part of the year, certainly, then I sort of gave him a call. I said, look, mate, I need to understand this a little bit more. Is this a mania? Is this what's going on behind it? So the first conversation we had was quite depth. It lasted a couple of hours. It raised a lot of flags for me, for someone who was, for all intents and purposes, in this technology, passively just observed, just from the sidelines. I didn't really understand it. It raised flags for me to the extent that I then got him to sort of present it to us, our team, and then we took, as I was taking that learning journey myself and with team, I sort of tested it with a couple of family offices that I thought, well, we'll present it to them and see what they say. And then, it was a 1 hour session, lasted, over a couple of hours. I thought, okay, well, maybe the people do want to learn about it. So then we got to another very large super institution in Australia. They again, spent a lot of time, and we might end up doing workshops with them in the future. Who knows? But so then we thought, okay, amongst our team, we need to, as we're going through this learning journey ourselves, maybe just open it to our broader audience, client base, who are also thinking about it, based mostly from fear, not understanding blockchain, reading here and there, but not really getting the in-depth on it. So here we are as a result of that sort of short 6 to 8 month journey we've had so far. Here's the presentation. What we'll do is, I've obviously gathered a few questions. Sorry, Haroon, if I'm going to repeat the same questions again.
No worries.
But I think they will be quite instructive. We may be able to pick up questions along the side panel here on Q&A. I'll try to get those along the way. And then this 1 hour is not going to make it. We're not going to be able to cover everything. It's really a sort of a just an observation into the what the technology is. You can sort of get a sort of a strip down of it. Haroon will peel it back, and then it's more of an appreciation opportunity. And then at the end of it, you can sort of get more of an appreciation of why is Bitcoin running the way it is with its price. Why is blockchain that's sitting behind Bitcoin and Ethereum and various other commercial uses of it, where is that all going? And then maybe we can have further conversation later on. So without further ado, Haroon, I'll pass it on to you. Quick blurb on yourself before we get into the conversation.
Oh, man, thanks, Max, for the introduction. As Max said, we're probably just going to scratch the surface on blockchain, Bitcoin. There's a lot to learn, but I'll try my best and open to questions. This is going to be a two-way session. So a bit about me. Besides Bitcoin, blockchain stuff, it's more of enthusiasm, bit of professional side, but I'm my primary roles have been in cybersecurity. I advise governments, institutions in APAC, Middle East, and Australia on cybersecurity strategies, compliance, encryption, and forensics. So in a nutshell, that's what I do. So I'll just start on quickly. Can you see my presentation, yep. Max?
Yes, I can see it. Yep.
Okay. So we'll be covering blockchain, just a bit of blockchain 101 to start with. Then we touch Bitcoin, and later on we go to DeFi, decentralized finance. Again, we're just going to talk on a very high level what it is and what's the future. So what is blockchain? Blockchain is it's a digital ledger holding transactional information across every node, every computer on the network. So every computer on the blockchain networks forms a blockchain. So what is a block? Block contains information of the transaction. So, and those blocks are connected to each other with something called that is a hash key and creating a chain. The advantage of blockchain is that information cannot be hacked, cheated, altered, or deleted, unless someone has a 51% superiority over blockchain. I'll go later on to that. It's a bit technical what 51% means here. Just a bit of history of blockchain. Started by individual into entity. We don't know who, but someone called Satoshi Nakamoto He launched Bitcoin, created the concept of blockchain, encoded it, and wrote the Bitcoin code and launched it in blockchain. And that's what we are running today. Fast forward today, 2021. So back then when it started, 2008, when Bitcoin mining was done, there were 50 Bitcoins per 10 minutes that were issued to miners. And today we're talking about just 6.25 Bitcoins issued every 10 minutes. And the price we've seen from not 0.5 to $50,000 today. Again, usually this presentation lasts pretty much as a day workshop. So I'm going to run through pretty fast on this one.
Haroon, just can I ask you a question on
blockchain, how it works,
Haroon,
transaction, be it money. Sure, mate.
Sorry, Haroon, can I just ask you a question?
Yeah, I can hear you.
Blockchains. Is it a set of computers that are owned by individuals or that are also called miners? Any individual that contributes computing power to that blockchain, a network of computers, effectively, as I understand, so they're a miner, basically. Is that what they're called?
Correct.
Yeah.
Correct. Anyone who contributes power are miners. I've got a slide on miners as well, and then explain you what mining is. But anyone who's part of blockchain is technically a miner who is assisting, pushing the transaction through from A to B. And he is getting rewarded with X number of Bitcoins for processing that transaction. I hope that's clear.
So there's two types of transactions.
How it works,
Haroon?
let's say.
Haroon, there's two types of transactions. One is actually creating a new Bitcoin, so to speak, and the other is moving coins from one wallet to another wallet. Is that what two types of transactions?
Correct. When Bitcoin is moved from wallet A to B, what miners are technically doing is they're solving a computation problem, a very complex mathematical problem, and they are getting rewarded for solving that, while at the same time that Bitcoin is being pushed through those mining machines, those supercomputers, quote unquote, through it, and they're getting rewarded for that in the form of Bitcoins. Now, currently they get rewarded as Bitcoins. Later on, because Bitcoin is finite, only 21 million Bitcoins will ever be made, which is estimated by year 2140, so 120 years from now. Once the Bitcoin reaches its finite level, which is a 21 million coin, these miners will stay on the network and they will earn fees, transaction fees, which will not be new Bitcoins, but technically they'll take part of your Bitcoin when you are sending X number of Bitcoins. So they'll take X minus fees and send it to point B. So that's on the high level of what miners do currently and what's going to happen after 21 million coins are minted. So transaction, when you send the transaction, it could be money. So again, blockchain use cases are not just money, but also data. So blockchain can be used for insurances, for document verification, legal, be it anything. So when you send that transaction, it's broadcasted to everyone on the blockchain network, and the network validates the transaction using a complex cryptography, sends it again to everyone in the network, and it adds to the block. When it adds to the block, a new block is created. It adds the previous block's information as well in order to create that chain. That's the concept where the chain comes in. So it links back to the previous transaction, to the previous, and back to the first one, and hence the transaction is complete. So this methodology applies on anything, be it money, be it document verification, or be it anything that you're doing on blockchain. So again, attributes recorded, it's transparent, and it's decentralized. I want to touch on decentralized a bit. Bitcoin blockchain is the only I repeat, the only blockchain that is truly decentralized. What decentralized means over here is, now the system that you currently use, let's say your Gmail, let's say your Outlook, they're all centralized systems. They all go to, let's say, a Microsoft or Google server, and they're all centralized systems. Decentralized is when there is no CEO, no CFO, no system administrator, quote unquote, and everything is run independently. So Bitcoin is the only blockchain that is 100% independent, and there is no influencing factor, no human being, no CFO, no accountant, no programmer that can alter, change, or anything. Why I say Bitcoin is the only true decentralized, because Ethereum and all these other blockchains that have come after Bitcoin, they all have a founder. They all have a founder that you can see, meet, touch, whatever you say, and who can influence their blockchain. No matter how much they say that it is decentralized, yes, Ethereum is decentralized. They're all decentralized, but because there are human influences, it doesn't become 100% decentralized. So that's where Bitcoin has an edge. That's why Bitcoin has that demand. And
Haroon,
continues to
can
grow.
you Haroon,
Transparent means anything that happens. Yeah, sorry, man. Yeah.
Haroon, can you give us an example of what that influence looks like? For instance, Ethereum or others that have emerged in recent years.
I'll give you an example.
Yep.
Yeah, like a few weeks ago, I don't know if you have come across the news where SEC, U.S. Security Exchange Commission, detained Ripple CEO, Ripple coin represented as XRP. They detained him, accusing him that he manipulates his coin price by holding majority of the coins, and he releases those coins at a set amount of time periodically in order to play with the market. So although his blockchain is decentralized as he claims, but then he plays with the price to his liking by releasing his coins or his stocks in conventional world in order to change the price to his favor. Now, this is what SEC has accused. I am not saying that. So this is an example of what not 100% decentralized is. And other examples can be, there are these fake ICOs or ICOs that you see. ICOs are like IPOs in conventional world. So again, so ICOs are launched by CEOs, CFOs, founders, so-called founders. They take people's money and then they play with the market on exchange and change prices. So that's the XRP case is a good example of what not 100% decentralized means here. Mm-hmm. Transparency, anything that happens on blockchain, pretty much every blockchain, it is visible to everyone without, let's say, signing up to an account. So if I send money to you, Max, and Zach can see, as long as he's got the wallet address of you and me or anyone, he can see if there was a transaction between us taking place without, without asking you for some sort of password or something. I'll touch on what those passwords or so-called private keys are in the next few slides. We talked about benefits and applications. Huge applications. We are seeing IoTs. We are seeing applications in healthcare where health records are being recorded on blockchain so that they cannot be altered or changed. And we talked about document verification where, for example, university degrees, data of university degrees is going on blockchain to prevent counterfeits. I've explained what blockchain is. It's the same terminology used in cryptocurrencies as well. It's immune to interference and manipulation by any government or entity or regulatory agency. In cryptocurrencies, I don't know how many of you have used cryptocurrencies or transacted, and if you have, you must have seen transactions on blockchain and everyone has a wallet address. So it is pseudo-anonymous. What that means is not 100% anonymous. One, because anyone can see what those transactions are and from where it is going to and to who it is going to. The anonymous part is those wallet addresses. So everyone has a wallet where you store Bitcoin. So those wallet addresses do not have a name attached to it. So you can't see the name when you're looking at a blockchain. So that's where it becomes pseudo-anonymous. However, when you transact using an exchange which is regulated by your current country's regulatory agency, let's say in Australia it is ASIC, that is ATO, it is Australian Financial AFL as well. They regulate that everyone who signs up to an exchange has a wallet, must provide their KYC documents. So they know that if this wallet is sending X amount to wallet B, they know it is Max who is sending it because they've got the documents and they know that they've tagged this wallet to Max. So that's where pseudo-anonymous comes in. There are coins out there which Australian government has banned them to use in exchanges over here because they are 99.99% anonymous, like Monero, like Zcash. It is extremely hard to find out the source and the receiver of those coins. And the way that blockchain is designed, it is designed for anonymity, and hence those blockchains are banned in Australia, and I think they're banned in US as well. Transactions are all stamped with information. Yes, mate. Yeah.
So is it? Are you saying it's a ban to have a private wallet holding coins, that you've got to go through an exchange to and the KYC process to have it sort of onboarded?
No.
Okay.
No, you can have a private wallet without going through an exchange. So you can create a Bitcoin wallet just using on your hardware wallet or on, let's say, blockchain.com or blockchain.info. You can create a private wallet. So when you do that, it doesn't have to be tagged to an exchange. An exchange is a place where, one, it makes it slightly easier for you to, get into cryptocurrency space, exchange with other coins. That's one of the primary reasons why exchanges are there. You can swap between different coins. Mm-hmm. And number three, it provides a safer environment to trade, so that you can stay within the law. Otherwise, with private wallets, it's very difficult to meet compliance, and then you could be in trouble if you were sending it to the wrong person, for instance. Mm. So the earlier question, yes, you can have a private wallet without going through an exchange. You can be 100% anonymous by, let's say, using a Tor network. You use a Tor network, have a private wallet, you send it to another private wallet somewhere in Ukraine. No one's ever going to know about it, who is who, as long as you do not tell your wallet address to anyone else. So this way you remain anonymous.
So who are some of the exchanges in Australia So who are some of the exchanges in Australia that are reputable, and what are some of the risks around holding on exchange?
Yeah, some of the big names are Coinbase, Binance, CoinSpot, and there's, I think, another one. The risks are, when you hold your coins in an exchange, the risks are that you're not holding that password to your wallet. The password is not actually the exchange login password. The password is actually the private key to that wallet, which the exchange holds. So that's the risk. So if exchange gets hacked, which has happened in the past, you lose your coins as well. So that's the risk that people take when dealing with exchange. But at the end of the day, you don't really have a choice when you want to stay within the regulatory framework. You want to be compliant, and you do not want to sort of break the law. I'm not saying having a private wallet is breaking the law, but when it comes to taxation, when it comes to having records of what's happening and what's going where and what, it's money at the end of the day, then you go via exchanges. So that's the risk with exchange. They hold your private key, and your coins are in their wallets. Although it's your wallet, but it's technically their wallet. And if they get hacked, you lose the coins. There are some exchanges out there which are called decentralized exchanges. So it's called DEX, D-E-X, where you hold the private keys. Usually those DEX exchanges are softwares that you can install on your computers. it's still on the technical space. It's usually used by techies out there. It's not. I haven't come across any user-friendly exchange out there that without knowing of what you're doing, you can use it. But yeah.
Is there insurance?
So that's one of the risks involved. And private key.
Is there insurance available for holding a wallet against theft on an exchange?
I haven't heard of insurances in Australia. I'm not sure if they will be heading that way, but I think they should be. But I do know of a company in US, which is not an exchange, but it's a platform like an aggregator for exchanges that provides insurance, because they are so sure about their security, cybersecurity, that they are providing that insurance. I do not know if Australian customers are fall under that insurance, or they can claim insurance if they become Fireblocks customer. The name of that website is Fireblocks. It's not open to individuals. It is only for institution trading, institution institutional cryptocurrency management. It's not for individuals, and but they do provide insurance. And these guys are the only ones I know of who provide insurance. Not anyone in Australia yet. If they do, I do not know.
Mm-hmm.
Yeah. So, any questions from anyone so far? Happy to answer. So,
there's a question here. I use BTC markets, which seem very trustworthy. You have a comment on BTC?
Yeah, BTC markets is trustworthy. Yeah.
Yep.
Yeah. Okay. Look, there are quite a few out there. I mean, I can list so many of them. They're quite trustworthy. BTC markets is one of them. But it is very important to know which exchange you're signing up with. You have to do your due diligence. You have to know what you're doing, even technically speaking. You have to know how wallets work. You have to know how money is sent from A to B, and do not 100% rely on exchange or exchange security. Because security, most part of it comes from human element as well. Technology all has its limits. So, cryptography, how cryptocurrency works here in transaction view. So public key, which is your wallet address. And so let's say Sally creates a Bitcoin wallet. She has a public key, which is the wallet address, and has a private key, which is the password to that wallet. Remember, this password is not the password to the exchange. So if I want to send a Bitcoin, or I want to receive a Bitcoin, I give my public key, which is the wallet address, to Jim. Jim sends 1 Bitcoin to my public key, and I receive it. The only way I can withdraw it, I need to have that private key. Now, the risks associated over here is, if you lose your private key and it's lost forever, you lose your coins, period, done. There is no technology out there. There is no system out there that can retrieve your coins because of the encryption involved. Okay. This is what a block looks like. Block contains data about transaction from person A to B. What is the amount? It contains the hash and a hash of a previous block as well. So that's how it makes it a chain. I can explain this hash, but it can go pretty deep. We've got a few questions to cover on later, so I'll just slide through this one.
Just a question for you, Haroon.
So this
is using something like a Nano ledger safer to protect your crypto from Nick?
Yes. Ledger Nano. Yeah, it's called Ledger Nano. It's a hardware wallet. So there are 2 types of major hardware wallets: Trezor and Ledger Nano. Trezor is Trezor, and Ledger Nano. So these are the the best ways to safeguard your crypto hardware wallets, because those private keys are inside that hardware, which even you do not know. Even if you have that hardware wallet, I've got some, you never know that private key to the wallet. That's the best way to safeguard your crypto. But if you lose, if you lose a Ledger Nano, it doesn't mean you've lost your coin. You can restore it when you commission a hardware wallet. When you start a wallet, they give you a set of passwords. They're keywords. They have different keywords like chair, like table, like things. I think they give about 24 such keywords for you to save, and you have to save it with your life. And if you lose that and you lose the hardware wallet, that's it, your coins are gone. So, but if you keep it safe, they are the best method against any hackers around the world. However, not 100% secure, in the sense that if you become complacent on your web browser, because web browser has different threat elements where there are methods of stealing your password things. So there are advanced threats out there that can steal. So the best way is to counter mitigate those threats is you should know which website you're on. You should know if that website is secure. You should know which browser extension you're using. It's a deeper discussion. I can answer those questions offline on security side of things. For now, I'll just move forward on understanding this more.
Haroon, there's a question. There's a question from you there, Haroon? Haroon?
Yeah, I'm here.
Yeah. So there's a question from
Yes.
Richard. He's asking, how realistic do you think the threat of quantum computers are?
Good question, Richard. Quantum computing is still at infancy stage, number one. Number two is Bitcoin has SegWit. If you know of SegWit, Bitcoin has been forked, soft fork, which is called SegWit, not the SegWit 2x. With the soft fork, the wallet address, which is the P2PKH, that is said to be quantum resistant. Why? Because it does not release your private key within the 10-minute space. Let me explain that as easy as possible. Now, in quantum computing, as of today, so Bitcoin uses SHA 512 encryption. As of today, quantum computing cannot decrypt that, number one. Even if someone builds that ultimate power of quantum computing, I think what will happen is there will be a soft fork before this in order to become quantum resistant. That encryption will become quantum resistant. But as of now, a quick answer is a maybe. Quantum computing could be a threat to blockchain encryption. But because of this soft fork, which uses a different wallet address, the P2PKH or P2PHKH, it doesn't release. So it doesn't leak out the private key while the transaction is happening within those 10-minute time window. And quantum computing is not fast enough to decode that encryption within that time. So with Lightning Network, let's say, so when Lightning Network, which is still at infancy stage, when that comes in and it is more adopted, because Lightning Network is super fast, super fast. We're not talking about 10 minutes. We're talking about milliseconds of transactions. That will make quantum computing even more difficult or near impossible to decrypt before the time runs out. Remember, once the time runs out, the 10-minute, why I say 10 minutes is after 10 minutes, it is replicated on every node out there. So on the entire chain, and quantum computing cannot decrypt the entire chain. So it has to decrypt at that 10-minute window, otherwise it will lose its opportunity. I hope I've been able to articulate this as in a layman's term as possible,
yeah.
Richard and Max.
No, that was very good.
Let me know
Good
if
explanation.
you've got more.
Let's push on.
Yeah. So mining is I've explained. Without mining, without cryptocurrency miners, you do not have blockchain. Period. But mining has become difficult since it has started, and that's the way Satoshi Nakamoto, quote unquote, programmed it this way to prevent inflation. So Bitcoin works like gold. Gold is scarce, Bitcoin is scarce, in order to mitigate the threat of inflation. So currently you've got central bank who can print money anytime they want. So let's say when there is a stimulus bill, when the economy goes down, people cry that they want money, government somehow increase supply. But Bitcoin doesn't work like that. So Bitcoin works on a set code, and it only produces X number of Bitcoins every 4 years. And after that, when it completes at 2140, estimated, by the way, there are no more Bitcoins. So I've put a slide over here. If you can see on the right-hand side, I don't know if I can put a laser pointer here. When it started in 2009, every block that a miner processed, it generated 50 Bitcoins per block, huge number of Bitcoin. So that's when people made a lot of money, a lot of Bitcoins. Fast forward to 2012. So what's happening over here is every 4 years, there's something called Bitcoin halving. Halving, it comes from the word half, HAFLF, halving. So halving means the reward per block reduces by half. So if you see, first block was producing 50 Bitcoins, 4 years later, the same block is making 25. Fast forward today, it is making 6.25 Bitcoins. At 2024, it will make only 3.125 until it reaches 0 Bitcoins, which is going to be the 21 million coin. Why this is important is, again, I told you inflation, and this is also the reason why Bitcoin price is going up, because supply is reducing, demand is going up. And I've explained, after 2140 estimated, miners will be paid transaction fees because there won't be any more Bitcoins that will be created or minted. How is it valued? I've explained on how on supply and demand, it's influenced by Bitcoin halving. So lesser number of Bitcoins created, more the demand, price goes up. Simple economics. Bitcoin price is also influenced by alternative currencies. Alternative means any coin that is not Bitcoin is an alternative coin, like Ethereum, like Ripple, like Stellar, like Litecoins, Bitcoin Cash. They're all altcoins. Although Bitcoin Cash it's Bitcoin, yes, it is a Bitcoin because it was hard forked. Hard fork means they created another blockchain out of Bitcoin and they forked it. But it is still an altcoin, so to speak. So that's another. So when other currencies change in value for X whatever reasons, let's say economics, let's say geopolitics, let's say regulatory changes in a country, in a major country, then you see Bitcoin price going up or down. So when Canada approved the Bitcoin EFT, I think 2 months ago, you saw Bitcoin price going up because that was seen as an acceptance of Bitcoin by such a large economy. Difficulty level. What is difficulty level? Difficulty is now, in order, Satoshi Nakamoto, it's not just he programmed that Bitcoin halves every 4 years, but what it also checks is every 2 weeks, the number of coins that are made every 2 weeks, it must not exceed in the next 2 weeks. So it sees, so after 2 weeks, it looks at how many coins were made in the previous 2 weeks, and it doesn't allow to exceed that number. And the maximum number of coins that are made is 210,000, I think, every 4 years. So it automatically adjusts the difficulty level. It increases the difficulty for the miners to mine that coin.
Haroon?
And when that happens, you create less coins. Yes, mate.
So just a question on the supply and
I can hear
demand
you.
side. So on the demand side, you've got two specific categories. So you've obviously got against the diminishing value of fiat currencies vis-a-vis the excess QEs that are just going to be into the oblivion. People have obviously traditionally seen gold as the reserve of value. Gold obviously has its own challenges of securely putting it somewhere, and again against the risk of theft and other matters. Now Bitcoin is obviously partially or is sort of on the way to fulfilling that role, maybe as a digital gold. So I think what you've said so far is there's obviously you've got to keep hold of your passwords and not lose them. So it probably does away with the storage part. You don't have to pay for the storage as much as you would for gold. So there's some benefit in that. But the other category that is often talked about, people trying to get their heads around on the demand side, is the transaction or it becoming a medium of exchange or currency. How realistic do you think that will be going into the future? I've heard things like it takes 10 minutes to do a transaction with Bitcoins if you're paying for something. I mean, Tesla's obviously accepted. I mean, if you're buying a $140,000 car, maybe you will wait 10 minutes, that's fine. But if you are going to go to a local bread shop, how likely are you going to pay with Bitcoin, in 0.00% of it?
Yeah. There are a few solutions that are coming up as we speak, and they're still at infancy stage. And one of them is Lightning Network. Lightning Network hasn't been adopted by major exchanges like Coinbase and Binance yet. However, some of the other major exchanges have adopted. So what Lightning Network is? Lightning Network solves this problem of 10 minutes issue, because you can't wait for a coffee at the counter and wait for the server to tell you that I've received the money, and you cannot afford to pay $20 or $30 of Bitcoin transaction fees as of today to pay for a $5 coffee. So Lightning Network solves these two problems. One is the time, and the other one is the cost. So what Lightning Network does is it is stripping away data from a block of Bitcoin, and it is running on a parallel, let's say, tunnel of the Bitcoin blockchain. It speeds that data in matter of milliseconds. So having said that, it also reduces the cost. So because it doesn't have to go through those mining, thousands of miners out there, and you don't have to pay that amount of fees. So I'll give you a perspective. Lightning Network, if you use a Lightning Network to send, let's say, don't quote me because these things can change every second. Let's say if you are paying $20 of transaction fee today on a normal Bitcoin blockchain to send X amount of Bitcoin, you would pay, let's say, 5 cents only on a Lightning Network. And that's one of the developments that is happening and moving at a rapid pace that will solve the problem of time and cost and become a store of value, a currency that people will start using on a daily basis. So currently Bitcoin is used online on transactions, maybe not at a coffee place yet, because Lightning Network hasn't been adopted yet, by major players out there yet. So that's one. Number two is there are platforms that are out there which are working on zero confirmation technologies, so it's based on some trust factor where it is when you are sending X number of Bitcoin, it is sort of putting it on an escrow, on a trusted escrow wallet. It's a bit technical. It's sort of putting it on that trusted escrow wallet. It knows exactly it is from you, and it is 100% you, and you had it before, and it is informing the receiver, do not worry about it, mate. It is definitely real. You do not need confirmation to give him this coffee, for instance. So zero confirmation. It is very new. It actually, in fact, just came in December last year or early this year. And I think only 2 exchanges out there. One is called FTX, I think, and there's another one I'm forgetting, who are using the zero confirmation model. But again, it is only for institutional customers yet, only because they do spot trading. So in spot trading, you need to move fast. You need to make fast decisions. Buy, sell, buy, sell, buy, sell. You can't wait for 10 minutes, for money to come in to make that decision. So these are the improvements that are happening, and I think by the end of this year, mid next year, you will see Lightning Network and zero confirmation models taking hold across various major exchanges and payment gateways. And I think this is what PayPal and Visa guys are sort of waiting for to happen, for this to get matured, so that they can jump on this ship as well. Because when you're doing a Visa transaction, you need speed. So currently, yes, Bitcoin doesn't offer that speed. Lightning Network does. So I hope that answers your question.
It does. It does. So to be clear, what you're saying is, fast forward another 5 years, it's a technology problem that is already seeing solutions coming to the marketplace. Obviously, they've got to go through their maturity process. Fast forward 5 years, if I'm holding Bitcoin as a reserve of my wealth, I will have opportunities to actually use it as a medium of currency, anywhere in the world, anytime. Right. Okay.
Yeah. Although you can use it now as well. You can use it now. You can buy an airline ticket. You can buy things where time is not a major issue.
Yep.
But when you're talking about coffee at a coffee counter, that's the change we're looking at in the next 1.5 to 2 years.
Okay.
Yeah.
All right. Can we just now be cognizant of time? Let's move on to the commercial users elsewhere of blockchain, just quickly.
So I'll just touch on smart contract Ethereum blockchain, which is a smart blockchain, but because Bitcoin blockchain is sort of dumb, so to speak. It doesn't do anything except money changing hands. So I'll touch on this because this is where the real applications of the blockchain comes in. Smart contracts. Smart contracts are contracts which are digital. Once the rules of those contracts are embedded inside the contract and put it on the blockchain, it cannot be changed. Remember, I said anything that goes in the blockchain cannot be changed, cannot be altered, cannot be deleted. So once a smart contract goes in the blockchain, you cannot change it. So this is where DeFi comes in as well. DeFi has used this smart contract. Yes, mate.
What problem, real world problem, like what problem is smart contract solving, like in a simple layman's terms? What is it? What it sounds like? Yes. Yep.
Yeah. One of the problem it is solving is, let's say, in a document, in a certification perspective. So when I put in when I enter a data, let's say of someone who is to be issued a certificate, from a trusted entity, the data comes in. Smart contract issues a certificate to that under the name of that person. So that's one application. Another is in a DeFi environment, the decentralized finance is when I'm a lender, so I lend money to smart contract, and the smart contract gives out money to a borrower, and smart contract makes sure that I get the interest for the money that I've lent, staked, which is the staked is a word used in blockchain in DeFi, and smart contract ensures I get the interest that I'm earning for the money that you have borrowed from the smart contract. So that's another major use case, and that's where we have seen DeFi, being I think a 20 billion or 18 billion US dollar market as of today, starting mid of last year. So So that's a major use case there, Max. Changing money hands. So it's like a bank. So it's acting like a bank. A simple smart contract is like a bank, giving out loans, giving out insurances, giving out money against a collateral, of course, because that's the only way it ensures that the borrower is able to return back the money. So when someone is borrowing from the smart contract, he actually gives the collateral also in cryptocurrency format in order to borrow. So that's one major use case. I've told you about this, let's say, certificate being issued, and anyone can go and check the smart contract if that certificate was authentic and it was actually issued to Max, and it was initiated by a trusted authority, which is, let's say, Australian National University, for instance. So, but the major use cases that you're seeing now are on the finance side of things, smart contract. On the IPO world, which is called ICO in blockchain, in crypto world, initial coin offering, smart contracts have played a major role where you give in Ethereum coins. In exchange, it gives you X number of coins of that project, ICO project. So let's say when Facebook launches its Libra, or I don't know what's the progress, it's a bit controversial because of Facebook. If it would work on a smart contract model, you would give in Ethereum coins, and in return, it would give you X amount of Libra coins. So that's another use case of a smart contract. Okay, and then you would use those Libra coins, let's say, to send money to your friend over WhatsApp or Facebook Messenger. I think that's one of their use cases. And then that receiver can exchange those Libra coins back into Ethereum and withdraw it from an exchange, unless Libra is recognized worldwide by all exchanges, and then you can withdraw as fiat currency. Yeah. So DeFi. Go, man.
Sorry, can I just ask? You just talked about able to exchange into fiat currency and back and forth. A key question is around, I guess, liquidity, the accessibility, the ease which you can go back and forth. Would that have any impact on, I guess, movement in prices? If liquidity is not there, I mean, how easy would it be to go back and forth between fiat currency and digital or Bitcoin or these currencies, and how might that impact actual, I guess, the price movements?
Yeah, look, going back and forth between cryptocurrencies is pretty easy and straightforward using exchanges. You can do it in minutes, you can do it in seconds. But going from crypto to fiat, you obviously have the price, there are price fluctuations on fiat side, and there are price fluctuations on the crypto side as well. So when you go from crypto to fiat, you either gain or you either lose, the value of fiat or the crypto. And that's where also stablecoin comes in. So what people do is, like stablecoins, which are pegged to a fiat currency, let's say US dollar, like US dollar T, USD Theta. It is pegged to US dollars. So people buy X amount of US dollar Thetas, which is USDT cryptocurrencies, because it represents an actual fiat $1 to 1-to-1 ratio. They use that in the form, use that to buy or sell other cryptocurrencies and then withdraw in Theta. So because whenever you withdraw Theta, you always get that fiat value because it's 1-to-1. But
I think just
so I hope that answers your question.
I think just to add to that, clearly, if you have lots of people wanting to convert from US dollar into this particular Bitcoin, for instance, where it's got a finite reserve, that's why the value is going up, against the US dollar. It's the more pervasive the use cases become for using Bitcoin, whether it's, you know, through smart contracts now available to lend to people who want to take on Bitcoin, and then, you know, and whatever do with that loan in Bitcoin, and convert it elsewhere into another crypto or back into fiat, not sure. But that sort of, that velocity of need through the economy and more of it, that's where the demand factor comes in. I think that's where the price fluctuations happen against US dollar or any other versus Bitcoin. Other cryptos, hard to tell, because as Haroon mentioned, they've got an entity behind them, CEO behind them. They're probably not that, the transparency is not there in terms of how much they can produce or manufacture, from what I understand so far. You know, that it's almost like, you know, they can run their own QE equivalents, you know, produce when they want to win. So, yeah.
So can I just ask? I mean, I guess it depends on how much the price is fluctuating as well, especially if you're doing it every day as a business. But just another key question for you, Haroon, is obviously ESG is a big issue now, and obviously to mine and all the energy required, electricity required to support digital currencies, cryptocurrencies. I mean, what's your view around that? You know, how should investors, with their environmental bent to their view or outlook, how should they be thinking about the viability of this from an electricity consumption point of view?
See, at the current value of Bitcoin, it is quite lucrative from mining perspective. So I mean, with the current, let's say, electricity value or the cost of running those machines, it is far less than the amount of money that you can make with mining because of the Bitcoin value. So when the problem happens is when the price crashes really, really low, which it did, you know, a year and a half ago, when it was really low, it was touching 2,500, 3,000. So that tilted the balance where electricity costs were high and you were not getting those returns. So that's when you see lesser miners. It's not lucrative enough, but miners are still there, you know, because of the incentive. So remember, when miners also reduce, it doesn't mean that the other miners make less money or it's not lucrative enough. It's just that the congestion becomes less, they get more requests to transact, and they get more reward. But at the end of the day, it also depends on how much power you're putting in.
Let me add from the ESG point of view, there are power suppliers that supply these blockchain networks that are looking at green sources of energy, whether it's solar, you know, wind turbines. So that those input of energy can be green sources as well. So it actually, you know, so you know, it can be done in a green way. And the other point is that it seems to me that the demand for power through the networks, distribution networks, electricity distribution networks, is increasing. You've got lithium batteries. You know, people are going to be putting lithium batteries in the back of their cars, and you know, backing into sort of a wall somewhere. And then you've got these, you know, blockchains needing power supply. The demand for, you know, those networks is just going to go up in terms of transmission nodes for that power. You know, that's separate from power production. Yeah,
and also you will see a lot of mining is done in cold countries like Canada, Russia, Northern Europe, because you do not require, because it's cold, you do not require, you know, cold intake to cool the rooms, so to speak, because it generates so much heat. I'm talking about Bitcoin mining here, not any other coin mining. It generates so much heat. It's a huge issue. But with today's Bitcoin price, even if you mine in, let's say, Dubai in July, where it's really hot, but as long as you've got the AC on, even with that electricity bill, you're still making money with today's price. So miners, they also move around looking at the right location to mine. And mining is also being improved on other coins. Let's say on Ethereum. So there's something called ETH 2.0 that's coming up whoever asked that question. ETH 2.0, which is said to be green blockchain. It's green because the way it works. So Ethereum works on proof of work. It's a deeper discussion what proof of work is. ETH 2.0 works on proof of stake. Because the blockchain works differently, it doesn't require that amount of power to process the transactions. That's why they're calling it as green. So that means what I'm trying to say here is people will be able to mine or stake either of the two, literally using a small computer connected to a USB stick or a PowerPoint at home without worrying about massive fans or heat coming out of it.
Yeah.
So it's just running on DC volts. Yeah. So these technologies will improve. I do not see Bitcoin, any improvement on Bitcoin. Bitcoin blockchain will always remain as it is. And people will look for greener methods to mine. As you said, Max, lithium batteries, yeah.
Haroon, so cognizant of time, let's. There's one more question before we go. I think we'll just have to sort of end it here, and because it will go well over time otherwise. So there's one last question I'd just like to highlight to you. Daily miners' revenue is $50 million per day. Who pays these fees if there are no Bitcoins left to mine? Transaction fees will be too high. From Michael Cornips.
We don't know if transaction fees will be too high because remember, by that time, Lightning Network will take hold. There could be soft forks as well that could reduce those transaction fees. It's hard to say as of now on what improvements are coming parallelly to improve speed and transaction, because those improvements are on both verticals, which is speed and transaction cost. So and who's paying that? People will pay when they want to transfer their Bitcoins from A to B.
Okay. All right. Yeah. Okay. Well, it's a riveting conversation. Let's maybe we'll do another follow-up webinar. I'll pass it on to Tim. Thank you very much, Haroon, for your insights once again. I'll pass it back on to Tim. Thanks.
Yeah. Thanks.
Okay, that was fantastic, guys. Really, really informative. So once again, thanks a lot for coming on today. Now, if you want the recording to this webcast, we will load it up onto our YouTube page. I'll put that back, the URL for that page into the Q&A box again here. If you're interested in these types of topics, and I'd love to do a follow-up webcast on this, by the way, guys. But if you're interested in anything to do with trading, investing, we're always regularly putting up new content. All right, there's at least a couple of videos a week on our YouTube page. Please subscribe. Please support us. We're here to give you free information and keep people informed around topics like, blockchain, Bitcoin, but also how to trade the markets as well. So look, I can't thank you enough, Zach, Max, and Haroon. Great presentation today. From it. And hope to get you guys back on soon.
Thanks, guys. Have a good day.
Thank you. Thank you.
Thanks, everyone. Take care. Bye for now.
Thanks, mate. Cheers, bye.